What we see when we look at the stock market is we see thousands and thousands and thousands of companies priced every day, and we ignore 99.9% of what we see, although we run our eyes over them. And then every now and then we see something that looks like it's...
When people talk about gambling, you'll often hear the phrase, "The house always has the edge," which just means the odds are mathematically stacked against you, and investing in stocks works the same way, except instead of the casino, it's firms like BlackRock that hold the edge. Luckily for us, there are investing strategies that are almost guaranteed to make money over the long run, but you won't learn them in school or from the bot comments under finance videos selling AI-generated ebooks with AI-generated covers and summaries nobody read. Ironically, investing is one of the few skills in life that's best learned from people who are really, really bad at it. People who move their entire life savings into a Robinhood account, put half into one penny stock, and then, to manage risk, put the other half into a tech company that's already up 50% this month. Bad investors don't just invest money, they invest emotions, and every quarter they'll tell you the company will be profitable next quarter and that they've built an advanced forecasting model predicting the stock will explode any day now. Maybe they're right, maybe they're wrong, but one of two things always happens. Either they lose 80% of their money and then lose the remaining 20% trying to earn it back, or they get lucky, double their money, and then lose everything trying to double it again with a different stock. The difference between a plus 100% investor and a minus 100% investor isn't skill or intelligence, it's which four-letter ticker they happen to gamble on, just like putting $10,000 on green at a roulette table. If it hits and pays out $350,000, that doesn't make you a good gambler, it just means you picked the right color once. Before even talking about investing, you might be lying awake worrying about the AI bubble or imagining a future recession triggered by something absurd, but the safest long-term investing approach comes from John C. Bogle, founder of Vanguard, who saved investors an estimated $1 trillion in fees by letting profits flow back to shareholders instead of himself. That philosophy is laid out in the Little Book of Common Sense Investing, which explains the passive free fund portfolio, a U.S. total market index fund, an international total market index fund, and a bond index fund. Technically, the best investment is whatever makes you the most money, which is why people say index funds are the best. Even though you could have bought Dogecoin in 2020 and sold in 2021 for a massive return, the odds of picking the best investment are extremely low, so what you actually want is the optimal one. Index funds are optimal because, based on historical data, math, and research, they offer high expected returns with relatively low risk, not safe, but predictable. Risk simply means actual returns can differ from expected returns, and while cash is reliable, inflation quietly erodes its value every year, which is why bonds offer slightly higher expected returns and stocks historically offer the best risk to reward trade-off, with the US market returning around 10% annually over the long term. Total market index funds capture this by holding thousands of stocks weighted by market cap, meaning most of your money goes into large companies, while smaller ones make up a tiny portion, and while that concentration can feel uncomfortable, chasing thematic or questionable ETFs often makes it easier to panic sell. You might beat the market once, but beating it consistently for decades is virtually impossible, so the optimal move is owning the entire market, including international stocks, adding bonds for protection, keeping fees low, and letting time do the work. The stock market is predictable in one way. Some people beat it briefly, some lose everything trying, and others forget they even invested and still outperform nearly everyone, which is why you don't want to be a day trader. You want to be the person who makes day traders mad.
If you buy something, a farm, an apartment house, or an interest in a business, and look to the asset itself to determine whether you've done something, what the farm produces, what the business earns, and so on, you don't really care whether the stock market's open. You can do that on a private basis. In fact, you do it on a private basis if you buy a farm or apartment house generally. And it's a perfectly satisfactory investment. You look at the investment itself to deliver the return to you.